Hey everyone, welcome back to another special in-person, in-studio episode of the Julia La Roche Show, where we are joined by none other than Danielle DiMartino Booth, CEO and Chief Strategist of QI Research. Danielle, it's always my favorite time when we get to have you in studio, so really appreciate you.
I'm happy to be here. Truly, I am.
Yeah, post-FOMC and also your birthday. Happy birthday to you.
Thank
really
you.
wonderful celebrating you.
That was amazing. Yes.
It really was amazing. So let's start. Your reaction, a 25 basis point rate cut, one dissenter. What's your takeaway from what we saw this week?
So I was actually visiting with some clients this afternoon, and I summed it up so succinctly, I'm just going to repeat it. The Fed chose independence over the economy.
Elaborate a bit more on that.
The Fed is under a full frontal attack. I mean, nobody would disagree with that. Right now, the fate of the Fed, if you will, could be in the hands of the Supreme Court and what they decide about Governor Cook. But more importantly, as to yesterday's meeting, you have to remember that Jeffrey Schmid and Alberto Musalem, this is Kansas City, St. Louis Fed presidents, their views on inflation are hawkish enough that they might have otherwise dissented in favor of no rate cut. And then you've got on the opposite end of the hawkish dovish spectrum, you've got Christopher Waller and Michelle Bowman. Mm-hmm. Because they dissented in July, that implied that they believed and actually Christopher Waller made a speech to this effect. I think the name of the speech was, "Let's get on with it," meaning let's get on with this easing cycle. I think that they would have dissented for a 50 basis point rate cut. And yet, when I say effectively, I mean it, we effectively got no dissents from Fed policymakers, as opposed to the sitting chair of the Council of Economic Advisors.
Okay, so on the Waller side, what do you make of his decision or not dissenting?
He could have very well sacrificed a shot at being the chair of the Fed with this one non-dissent. I would certainly think that, and the same could be said for Michelle Bowman. Her name has been thrown around as well. And, to that, it's very rare that I would say, score one for integrity at the expense of U.S. consumers and households who are struggling right now. We just got a new business roundtable CEO survey out, and it shows that companies are going to continue to reduce headcount, and it shows that hiring freezes are going to remain in place in the private sector. The data that we're getting on the job market is not improving. And even according to Christopher Waller's own formula, because he told us in his most recent speech how he views the labor market. Mm-hmm. He views it through the prism of the private sector, but he views it through the prism of the private sector net of healthcare and education. Because people are always going to get sick and people are always going to be going to school. So we consider these sectors to be quote unquote recession proof. They're not cyclical industries, even though we're seeing layoffs pick up appreciably in healthcare as artificial intelligence begins to rationalize even the healthcare sector and how that is delivered more efficiently. So if you look at that through the prism, what Waller calls the core private sector, the U.S. economy has not created job one since April.
Gold keeps setting new all-time highs, but price appreciation isn't the only way to profit from owning gold. Monetary Metals is redefining the future of precious metals investing. Instead of paying to store gold, imagine getting paid to own it. With Monetary Metals, you can earn up to 4% on your gold, paid in physical gold. That's right, your ounces grow each month, not just your paper balance. A yield on gold, paid in gold, means you're stacking more ounces every single month. And you still benefit if gold's prices rise. You're earning more gold every month and enjoying potential price appreciation at the same time. Go to monetary-metals.com/Julia to learn more and see how you can start earning 4% on your gold, paid in gold. That right there, the US economy has not created one job since April. I want to give you credit because we saw that massive downward revisions. You have been on top of this for a long time and you deserve the credit.
Well, thank you. And it's not been fun to be, she's called however many of the last year census. And I'm like, no, actually, I've said before and in public forums exactly when I think job losses began. Mm-hmm. And now we have the data in hand that shows that that's when job losses did begin. The U.S. economy was in recession in the second quarter of 2024. We know that. Do markets care? No. That's why our mantra at QI Research is trade the narrative, own the truth. Because markets trade off of many different things, mainly flows, passive flows. And they care about the narrative. They care about where the biggest hedge funds in the world are positioned and being positioned with them to profit with them. If they're active investors, and if they're passive investors, money just plows in twice a month via 401ks. So it's not so much a market call, but you need to know where the economy is in a cycle. We need to know that the economy, because job losses have never begun in U.S. history until after the onset of a recession, ever. Mm-hmm. So we know that recession started sometime in the first quarter of 2024, prior to job losses commencing. There's a good shot at job losses coming out for a brief spurt of enthusiasm and kind of promise of change around the U.S. election. But we know also now with real-time revisions. So these are the revisions that are reported every month for 2 months. Now we know that the pandemic notwithstanding and the noise that was associated with the pandemic, that in June 2025, the U.S. economy shed jobs on a net basis for the first time since September 2010 in terms of real-time economic data being reported. Now, we always get revisions at inflection points in history. And now we have to go through the second and third derivative exercises of backing 911,000 fewer workers in the economy in the year ended March 31st, 2025. Now you have to back that out of income. You have to back it out of GDP.
It changes all the models.
It changes the models. Yeah. And that's why in the first quarter of 2001 and in the first quarter of 2008, it took 5 quarters before we actually knew that we had been actually in recession, that the number in front of GDP was not a positive, a plus sign, but a negative sign.
Do you think are we still in recession then?
Well, we're certainly in recession it looks like that job creation peaked in May.
Okay.
And then started to fall. In fact, there was something fascinating about the market's initial reaction to the continuing jobless claims data for the first week of September. And we're complete wonky dorks at QI Research. We love to dig in the weeds of the data. And so something didn't make sense when we looked at states by states. And lo and behold, the number of individuals in the state of North Carolina collecting jobless benefits did not go from north of 20,000 to 200 in 1 week. Rather, it was a typo. So we actually had continuing, according to the Department of Labor, so we actually had continuing jobless claims rise to the highest level in more than a month instead of falling this morning, which is why the 10-year, which has kind of had a bad, ugly ride since the Fed decision came, because it was Powell called it a risk management.
Yes, I wanted to ask you about the risk management cut. Yes.
Meaning we may be pausing again in favor of the inflation mandate. But we now know, and so the 10-year popped all the way up to, I want to say, 414 today before it closed at 410. And it closed. And it went
below 4 yesterday.
Right. It dipped below 4 yesterday. But as soon as that news began to circulate around chat rooms, starting in my chat room for our pros, then you saw the 10-year come off the high yield of the day. Because they were like, oh, we did not see a major decline in continuing jobless claims. We actually saw a sizable increase.
Yes. Okay. Why do you think it is that the market has not recognized we're in a recession? Because it makes me wonder, Danielle, like, gosh, if you look at who owns the asset prices, they sure seem to like be great. They probably aren't in a recession, but when I see folks who comment in the comments section, there are a lot of people who feel like they are in a recession. So does that also illustrate
they're not alone,
a K-shaped economy here? I
don't think the letter K is appropriate anymore. I mean, we're going to have to invent a new letter, because as Moody's announced earlier this week, the top 10% now account for 49.2% of consumption in this country. That same top 10% owns what, 87% of the stock market, something along those lines.
And they probably own homes.
They own homes. And they're not feeling a recession. But is the letter K appropriate when you're only talking about 10% of the U.S. population?
I don't know what the letter would be, but yeah.
Yeah. I mean, University of Michigan, we just saw the percentage of individuals expecting the unemployment rate to rise in the next 6 months is at 65%. Those are your comments. Because 65% of Americans know that the unemployment rate is going to rise. They know that the job market is in a recession.
Yeah.
And we've never gone over 50% and stayed over 50% as we have since April without the U.S. economy being in recession.
Do you think we're headed into a double dip recession?
I think we're in a double dip recession.
In a double dip. Okay.
That is our firm's actual call right now.
Can you elaborate a bit more on that? Yeah.
Well, we know job losses commenced in the second quarter of 2024. So we know that the economy was in recession in 2024. Again, there was a lot of enthusiasm. There was a burst of confidence around the presidential election. Our company's going to unleash just crazy amounts of CapEx and start hiring in the private sector. Of course, the CEO roundtable for the third quarter just told us the answer is no. But there was that burst of enthusiasm, and then we slipped right back in. So the closest historical corollary that we can draw was kind of the brutal double dip recession of 80 and 81. And we forget that President Jimmy Carter at the time had grown federal payrolls, and that Ronald Reagan came in after Inauguration Day and slashed federal payrolls. And we haven't seen that in the data yet, by the way. Reuters estimated that 248,000 federal workers had accepted the buyout. Okay, well, the vast majority of them, their severance package ends on September the 30th, in just a few weeks.
And that won't get counted until
they file for unemployment, unless they've gotten jobs. But we know
it's hard to get a job right now.
Yeah, we know that the long-term unemployed, those who have been unemployed for 27 weeks or more, half a year or more, and they become stigmatized. Employers don't want to hire them because they've been out of work. But we know that the level is north of 25% of the unemployed who've been long-term unemployed. That scarring is very problematic and indicative of the fact that if you lose your job, you're not getting another one.
And that might also explain in the labor data, you've seen a lot of people who've become like consultants, or they're doing more gig work. So that might look like it's a job, but it's not the job that they want.
No, I mean, since January, okay, so this is in the last 9 months, we've lost more than 1.4 million full-time jobs. These people want a full-time paycheck. I can promise you that. They are not covering the rent. They're not covering their essential spending with a part-time gig work. They're not, whatever they're putting on LinkedIn, their initials .llc, so that they can show work continuity. That's not paying the bills.
Do you think this is all going to like come to a head?
So there, to be fair, the same CEO survey that just hit the wires did show a slight uptick in capital expenditure intentions. Now, this is the one stimulative, potentially the one stimulative aspect of the big, beautiful bill. Because companies know that starting next year, they get to depreciation, they get tax breaks. And that has spurred economic activity in the past. The caveat here is the same survey shows that, again, they're not planning on hiring more people. CEOs are indicating we're going to plow money into cost-cutting endeavors to increase what one worker can produce for us.
Use AI.
And that's exactly what they said, Julia.
Increase the productivity of the person. Don't increase your head count. Yeah.
Mm-hmm. So will this all come to a head? You know, this is going to be the first year, I think, in U.S. history. This is according to somebody else's calculations, who's a demographer. But this will be the first year in the history of the United States that we see population contract. So if you think of the unemployment rate, the denominator is the size of the workforce. The numerator is the number of unemployed. Well, you're shrinking the denominator appreciably with all of the outmigration and deportations, which means you need to have less unemployment. Unemployment needs to increase less to move that unemployment rate up more.
Let me ask you this, going back to the Fed, their mandate, it's dual mandate. Even Chair Powell yesterday talked about the tension between the two and trying to strike that balance. Does the mandate even make sense?
No. The mandate, we're bringing up Jimmy Carter twice, and I think he was an amazing, wonderful statesman after he left office. He was not good with economics. But the economy was so bad that in 1978, the second mandate was added to the Federal Reserve. That was a Jimmy Carter era expansion of the Fed's what had been lender of last resort in times of financial crises and inflation. And that was it. But they add something that's inherently in conflict.
Yeah.
Because when you want to minimize inflation and maximize employment at the same time, I want to juice the economy and I want to slow the economy down. Which is it? So they've been in conflict with one another. It's part of my book, Fed Up. I have long time advocated for Congress to go back and rewrite the Federal Reserve Act to amend it back to just minimizing inflation.
Has there ever been like a conversation about that you know of? That
there are generations of libertarian-minded individuals in Congress are aware of this. But Congress is an interesting beast because they haven't done much for the country lately. Well, they haven't done much for the country since Alan Greenspan came to office. It's been so much easier to avoid legislation and just push all the pressure over to the Fed. You fix it.
But maybe they can't, because if they're in conflict or it's contradictory, it's
exactly
what can you really do?
Exactly.
Okay. You mentioned your book, Fed Up.
This is why I like it when you interview me, because you're a smart cookie.
You're very smart, and I love learning from you. Okay, you mentioned your book, Fed Up, an insider's take on why the Fed is bad for America. I think I got the title right. There you go.
You did.
Okay.
Made me so popular at the Fed, that subtitle. Ooh.
Oh, I love it though. If you were to write a book today, what would you write about? Or maybe an update to put up. What would you add?
I would write about the unexpected, and we've spoken about this before. I would write about the rude awakening of the United States and the world economy, discovering that the Fed put is dead. It is going to be the rudest of awakenings. Now, here, we're going to go Socratic for a second. What does the average investor, what are they saying when they say the Fed's going to rescue the markets?
The stocks are just going to go back up.
But what would the Fed do to do that?
Cut rates.
How much?
How much?
How many people are talking about, thank you.
Yeah,
because
the zero bound.
Once they get to the zero bound, then they can launch
quantitative
easing. So when people today talk about the Fed will run to the rescue of the markets, they're talking about the Fed going to the zero bound and relaunching QE. Period. End. That's how they interpret it, because that's the world we've known since 2008.
It's the recency bias. Yeah.
But that worked in 2008 because the labor force participation rate among individuals who were 55 and older increased appreciably. The boomers went back to work. They kept their money in the stock market. 72% of the U.S. portfolio is in the stock market. 20% is in cash. The balance is in fixed income. 40% of the stock market is owned by individuals who are over the age of 70 and older. The median age of baby boomers today is 71. Mm-hmm. They own 40% of the stock market. They own 25% of the housing market. What happens? We're still doing Socrates here. And we've talked about this before. What happens at the zero bound for all those boomers? Because we know what they did in 2007. We know what they did in 2001.
They're going to sell. Are they going to sell?
Are they going to? Are most 71-year-olds going to rejoin the workforce?
No, they're definitely not going to rejoin the workforce.
Okay,
or maybe they have to. But I don't know. Like, what are the opportunities if you rejoin? Are you going
is there a hiring freeze on?
Well,
do they have AI skill sets?
I was going to say, yeah. Or you do like gig economy work, but then like I don't know if they're robo-taxis. I don't know.
A ton of octogenarian Lyft drivers and Uber drivers these days. I do. It's sad.
It is. Yeah.
It's tragic. But those are what you would consider to be stopgap measures. But I'm talking about the 40% who are sitting pretty. I'm talking about people who are over the age of 70 who own 40% of the stock market. They're not going to go drive for Uber.
No.
And if you go to the zero bound, yesterday they were making 4.25. Today they're making 4% on their cash. Mm-hmm. How low can the Fed go? We don't know. We don't know. Is it probably closer to Treasury Secretary Scott Bessent's 150 basis points? Can we go to that threshold? That would kind of break below 3% that they're making on their money market fund. Would that would probably cause them to rotate into dividend-paying stocks to generate an income, cash flow stream.
And because they're probably also on a fixed income too, because they don't have a job either. They have to also, people are living longer too. So you have to think about longevity and what you can take out every single year.
And how expensive healthcare is as a factor of your aging.
Yeah. And then also there's going to be in-home care, or they might need help. Yeah.
So is the Fed put dead? That's what I would write about. Because the zero bound, when every 0.5 percentage rate cut, every 50 basis points takes $70 billion of interest income out of the hands of retirees, you're playing with fire if you go to the zero bound. Because why is the stock market up, Danielle? Why is good news good news? Why is bad news good news? Why is any news good news for the stock market? Because Passive is a beast. 2/3 of the flows into the market. Automated.
Do you think that's what's been holding everything up then?
Oh, gosh, yes.
Yeah, the passive flows.
Oh, gosh, yes. Absolutely.
And no one's really seen what that looks like when that reverses.
Never been stress tested. Not in U.S. history. Never been stress tested.
That's what Mike Green often talks about. Yeah.
Ever. But if the Fed were to go to the zero bound, like most crazy, foaming at the mouth stock market bulls are like, the Fed will ride to the rescue. We'll go to the zero bound. They will relaunch QE. And I'm like, yeah. And then what does 40% of the stock market do if you're at the zero bound?
Mm-hmm.
Then you stress test passive for the first time in the history of indexing.
That would be very ugly. Oh, wow.
Which means the Fed put
is no more. Doesn't work. Yeah.
But I mean, as things stand, FedUp still sells very well. I dare say our Treasury Secretary has read it because he sure has been echoing my final chapter, shall we say, in things he's written.
Remind me of the final chapter.
The final chapter is there's nothing less satisfying than reading a book that's like, excuse my French, I know this is a family show.
No, you can cuss on the show.
A bitch fest. You do not want to read a bitch fest without saying, okay, now what do we do about it?
Mm-hmm.
And so the final chapter talks about 1913, the U.S. economy, St. Louis, Chicago, Minneapolis, Kansas City. These were huge, booming railheads. Why do we have all of those Federal Reserve district banks where they are today when you could have one in the Midwest? Cleveland Fed. I mean, my God, there's 5 of them.
Yeah.
But you could certainly have one. And by the way, former Treasury Secretary, former Fed Chair Yellen, things really go wrong in that 12th district. I mean, Countrywide, Silicon Valley Bank, but you just needed a 1/12th district to cover, I don't know, half the geography of the United States in 1913. California wasn't the world's 4th largest economy back then.
Yes.
Now you have a deficit of supervision on the West Coast. So I would advocate for adding one on the West Coast, but getting rid of 4 in the middle of the country. We probably don't need...
You're right. It was a different time.
It was a totally different time.
Yeah, railroads and whatnot.
And do we need 786 PhDs to screw in a light bulb?
From the same school of thought.
Probably not. So it talks about that as well. It talks about bringing practitioners. The last chapter of FedUp talks about bringing practitioners who understand the intersection of the financial markets and Fed policy. Rick Rieder, he could walk through that passive theory in 2 seconds flat. He would understand exactly how monetary policy would affect the financial markets if you went to the zero bound again. Rick Rieder would get it. And he spent 2 hours visiting with Besant.
Do you think he's the front runner or could be?
I mean, cynically, be a great time to sell all of his stock holdings, which is a bonus. It's a perk, right? Ask Blankfein. Ask Cohen. Ask any of them.
Okay, so I have to ask you one final question before I let you go. And you've been very generous with your time. This week would have been the 17th anniversary of Lehman failing. Financial crisis.
September 15th.
Yes. September 15th. That's right. Monday. You were known for your call on the housing market and the financial crisis. You nailed it. Looking back over the last 17 years, what's a lesson you think we still haven't learned?
Well, that brings us back to Governor Waller. Governor Waller, in his very first televised interview after he was confirmed onto the Federal Reserve Board, said that home prices were on fire and that the Fed had no business conducting quantitative easing in the mortgage-backed securities market. And in fact, that is a violation of the Federal Reserve Act. The Fed is not legally able to conduct credit easing and to rescue one particular sector of the U.S. economy, as it's done not once but twice with housing, fully distorting the biggest asset on most Americans' balance sheets, not the top 10%, but the biggest asset on most Americans' balance sheets. And people were a little bit surprised. They didn't mention anything about the MBS roll-off. Kept it at $35 billion a month. Every month. I mean, they've reduced the Treasury roll-off to just $5 billion a month. But they're keeping that MBS going. I hope the Fed has learned that lesson. The flip side of it is we didn't know enough about the non-banking sector in 2007 and in 2008. I wrote briefings about it. We know less about it today, but it's gargantuan compared to what it was. Non-depository financial institution loans are up north of 20% year over year, whereas other conventional bank loans are flat as a pancake. We don't have $1 trillion of margin debt. We don't know how much leverage is in the stock market because the money that triple levered ETFs use is borrowed in the shadows. It's borrowed in the non-banking sector because things like Tricolor, a big subprime automobile lender that went kaboom because it had warehouse lines at not one, not two, but 3 banks. Same collateral. It's called an off-balance sheet loan. We used to talk about that in the days of WorldCom and Enron. But now we have it that it's just massive. And regulators need to understand better what has become the fault line. And that is the private markets.
Danielle, it is always a pleasure having you. Before I let you go, let folks know how they can find you, support your work. QI Research, The Daily Feather. I'm a paid subscriber to The Daily Feather.
Thank you.
You just celebrated your 10th anniversary.
We did. We've been cranking this research out for 10 years.
Any parting thoughts?
It's written all over my face.
Yeah.
Parting thoughts. You always ask me about parting thoughts.
The floor is all yours. Anything you want to say?
I would say give peace a chance. We have to listen to each other and be tolerant of one another's views in this country. And there's a leadership vacuum that has to be filled. Somebody's going to have to rise to the top in this country that quits trying to antagonize. And I'm talking about both sides of the aisle. We have to give peace a chance. We have to open our ears. I've raised all 4 of my kids, all 4 of them. Turn your listening ears on. Turn your listening ears on. We have to listen to each other in this country.
Give peace a chance. Well said. Danielle DiMartino Booth, CEO and Chief Strategist at QI Research, author of Fed Up, friend of this show. We always enjoy our conversations. Really appreciate you, Danielle.
Thank you for having me.